You have probably closed a trade too early because the 5-minute chart looked weak, only to watch the market turn higher without you. And you have probably held a losing trade too long because the daily chart still looked strong, while the lower time frames were already warning you that the buyers had lost control. The uncomfortable truth is this: a reversal often does not begin where you are looking for it. It begins in disagreement. A market rarely turns all at once. It changes character in layers. First, the smallest traders react. Then the short-term money adjusts. Then the larger time-frame participants begin to hesitate. By the time the reversal is obvious on the chart you trust most, much of the risk has already shifted hands. What looks like clarity at that point is often just the late confirmation that others have already acted on. This is why a trader who studies only one time frame is often too early or too late, and sometimes both in the same week. The lower time frame can tempt you with noise. The higher time frame can comfort you with delay. One makes every pullback look like a collapse. The other makes every collapse look like a pullback. Between them sits the real work, learning which movement is merely reaction, and which movement is the first sign of control passing from one side of the market to the other. You are not trying to predict every turn. That is a poor occupation. You are trying to notice when the market stops behaving the way it should behave if the old trend is still healthy. In an uptrend, strong buyers should defend pullbacks with urgency. Breakouts should attract fresh participation. Failed dips should be punished quickly. But when price begins rising on weaker effort, when pullbacks deepen, when recoveries stall at places they once cut through with ease, the market is telling you something has changed. The mistake is to treat every lower timeframe reversal signal as a command. A sharp candle against the trend, a broken intraday level, a sudden rejection from resistance. These can matter, but only in context. If the higher time frame is still accepting price, and the larger structure has not been damaged, then what you are seeing may be nothing more than nervous traders being shaken out. But if that same lower time frame weakness appears after the higher time frame has already stretched, slowed, and failed to attract continuation, then the signal has a different weight. You must learn to ask a more disciplined question. Not, is this the top? Not, is this the bottom? Those questions invite guessing. Ask instead, which time frame is changing first, and which time frame has not admitted it yet? That question will keep you from chasing every flicker of movement. It will also keep you from worshipping a trend after the market has begun withdrawing its support. A true reversal is not just a candle pattern. It is a sequence of behavior. It is pressure failing where it should have succeeded. It is confidence turning into hesitation. It is late traders entering where informed traders are quietly reducing risk. So before we speak of entries, confirmations, or exact time frame combinations, we need to understand the first principle: the market does not reverse because one chart says so. It reverses when different time frames begin telling different truths. And the careful trader learns which truth is arriving first. The first pressure you feel in a possible reversal is not in the market. It is in yourself. One chart tells you the trend is still alive. Another chart begins to show weakness. Price is not fully turned, but it no longer moves with the same ease. You can feel the disagreement before you can explain it, and that is where many poor decisions begin. When the timeframes disagree, the mind looks for relief. It wants one clean answer. It wants the higher time frame to excuse patience, or the lower time frame to justify action. If you are already in a trade, you search for the chart that protects your position. If you are waiting to enter, you search for the chart that gives you permission. The market has not trapped you yet. Your need for certainty has. This is why reversal trading is difficult. A true turn rarely presents itself as a neat announcement. It starts as a disturbance. The lower time frame may weaken first, but that weakness may still be too small to matter. The higher time frame may still look strong, but that strength may already be losing its force. Between those two facts sits the uncomfortable place where the trader must observe without rushing to name what he sees. You must understand what disagreement really means. It does not mean the market is confused. The market is never confused. It means different groups of traders are acting on different pressures. Short-term traders may be taking profits. Late buyers may still be entering. Larger participants may not yet be forced to respond. When these behaviors collide, the chart becomes uneven. Movement turns less clean. Reactions become sharper. Continuation becomes harder. The inexperienced trader treats that unevenness as a problem to solve immediately. He wants to call the top, call the bottom, or dismiss the warning altogether. But the better trader knows that disagreement is information. It tells him the old order is no longer being accepted without resistance. It does not prove a reversal, but it proves that the market deserves closer attention. That distinction is important. If you turn attention into prediction, you lose discipline. If you turn attention into observation, you gain control. Ask yourself what you do when the charts do not agree. Do you reduce the market to the time frame that flatters your opinion? Do you keep changing charts until the discomfort disappears? That habit is dangerous because it makes analysis personal. The chart becomes a defense mechanism instead of a tool. Once that happens, you stop reading price and start negotiating with it. A serious trader must learn to remain calm inside uncertainty. Not passive, not careless, calm. There is a difference. Calm means you can see early weakness without declaring a reversal. It means you can respect the larger trend without becoming loyal to it. It means you allow the evidence to develop in order instead of forcing the market to answer before it is ready. The practical work begins with naming the disagreement plainly. The lower time frame is weakening, but the higher time frame has not broken. Or the higher time frame is stretched, but the lower time frame has not shown control by the other side. That simple act prevents confusion from becoming impulse. You are not trying to feel certain. You are trying to know exactly what is uncertain. Once you do that, your behavior changes. You stop reacting to every small candle against the trend. You stop dismissing every warning because the larger chart still looks respectable. You begin to watch how price responds when it should continue. Does strength attract more strength, or does it fade quickly? Does weakness get rejected, or does it begin to hold? These observations matter because they show whether disagreement is expanding or being resolved. This is the first discipline of using multiple time frames. You must not ask them to comfort you. You must let them challenge you. One time frame may reveal urgency. Another may reveal consequence. Another may reveal delay. Your task is not to choose the chart that feels best. Your task is to understand why they differ and what that difference is beginning to cost the traders who are positioned on the wrong side. Only after you can stand in that disagreement without rushing does the next question become useful. When does observation become action? A reversal idea becomes dangerous the moment you treat it as a trade before it has earned that right. Price may hesitate. A level may fail for a moment. A small chart may turn against the old trend. But hesitation is not execution. A market can warn you long before it gives you a place to act, and the trader who cannot tell the difference will confuse early observation with opportunity. The purpose of using multiple time frames is not to find more reasons to enter. It is to force the trade to pass through order. First, the larger view must make the reversal possible. Then the working time frame must show that the old trend is no longer moving cleanly. Only after that should the smaller time frame be allowed to offer a trigger. When this order is broken, the trader gives too much authority to the chart that moves fastest. A lower time frame trigger without higher time frame permission is usually just activity. It may be sharp, it may look decisive, it may even work for a short distance. But if the larger structure has not become vulnerable, the move is often absorbed by the existing trend. The trader enters because the small chart is loud, then discovers that the larger chart was still in command. Noise becomes a trade because sequence was ignored. Higher time frame context alone is also not enough. A market can be stretched for a long time. It can look tired and still continue. It can reach an area where reversal seems reasonable and still punish anyone who acts before behavior changes. Context tells you the market may be ready. It does not tell you the market has turned. That difference is where discipline lies. The middle time frame often carries the most important evidence. It shows whether weakness is becoming organized. A single rejection on a small chart may mean little, but if the working structure begins to fail in stages, the trade starts to mature. Failed advances become more important. Pullbacks begin to travel farther than they should. Recoveries lose their authority. The old trend is still visible, but it now has to work harder to prove itself. Only then does execution have value. The small time frame should not be used to predict the reversal. It should be used to define the moment where the idea can be tested with control. You are not entering because the market has promised a turn. You are entering because the larger condition, the working structure, and the immediate trigger have finally lined up enough to make the risk specific. This is why a proper reversal entry often feels less exciting than an impulsive one. It does not come from catching the first flicker. It comes from waiting until the market has shown vulnerability, then deterioration, then a point of failure that can be acted upon. The trade is not born from one signal. It is built from a sequence of evidence. You should know, before entering, which time frame gave you permission, which time frame gave you proof of change, and which time frame gave you timing. If you cannot separate those three jobs, you are probably not executing a plan. You are reacting to movement. A serious trade should be explainable without drama. The larger chart made the reversal plausible. The working chart showed the trend weakening. The smaller chart gave a precise place to act. This does not mean waiting for perfect agreement. Perfect agreement usually arrives late. By the time every chart looks clean, the early advantage may be gone. The aim is not perfection. The aim is proper order. You want enough evidence to avoid guessing, but not so much confirmation that the trade has already paid others before you entered. So when you study a possible reversal, do not ask first, where can I get in? Ask, has the market moved through the stages that make an entry worth considering? If the answer is no, the trade is still only an idea. If the answer is yes, the next matter is no longer whether the reversal is interesting, but whether the risk is small enough and the possible reward large enough to justify taking it. The poor reversal trader wants to be right at the exact turn. The better trader wants to be wrong cheaply when the turn is not real. That difference may sound small, but over time it separates the trader who survives from the trader who keeps paying full price for his opinions. A reversal is never certain when it first becomes tradable. If it were certain, the opportunity would already be crowded, the easy distance would already be gone, and the risk would often be larger than the reward left on the table. This is why the mathematical value of multiple time frames is not that they make the future clear. Their value is that they help you compare the size of the possible move with the size of the necessary risk. The higher time frame gives you the scale of the opportunity. If that chart is extended, crowded, or near a place where the old move may be vulnerable, then a reversal can carry meaningful distance. But distance alone is not a trade. A large possible move with a large required loss is not an advantage. It is only a story with expensive admission. The lower time frame gives you the cost of testing that story. It can show a tighter point where the idea is either beginning to work or should be abandoned. This is where many traders misunderstand the small chart. Its purpose is not to make the prediction stronger. Its purpose is to make the loss smaller if the prediction is wrong. That is the arithmetic of reversal trading. You do not need to catch every turn. You do not need to be correct on every attempt. You need your losing attempts to be contained and your winning attempts to have room to expand. If the risk is wide and the reward is already reduced, even a good market opinion can become a poor trade. Think of it this way. A trader may see the same possible reversal on the larger chart as everyone else. But one trader enters where the invalidation is close and clear. Another waits until the move has already traveled, then enters after the comfort has arrived. Both may believe the same thing. Only one has the better equation. The market does not pay extra because your opinion is reasonable. It pays when your risk is placed well against the possible distance ahead. This is why prediction can become a trap. The more a trader wants to prove he called the reversal, the more willing he becomes to accept bad terms. He widens the stop because he wants to stay right. He enters late because he wants more confirmation. He takes a small target because he fears giving back profit. Each choice may feel protective in the moment, but together they damage the very reason for taking a reversal trade. Multiple timeframes should bring you back to terms. What is the larger possibility? What is the smaller cost? Is the trade asking for too much risk before it has proven enough? These questions keep the mind practical. They prevent you from turning a chart opinion into a position that has no mathematical dignity. A true reversal setup should offer a clean imbalance. The larger chart should suggest enough open space to matter. The smaller chart should offer a place where the trade can be tested without serious damage. If either side is missing, the setup is incomplete. A big possible move without controlled risk is temptation. A tight risk point without larger potential is just a small gamble dressed as precision. This is also why a trader must not confuse being early with having edge. Early can be useful only when the cost of being early is low. If you are early and wrong, the loss must be small enough to leave you steady. If you are early and right, the higher time frame must have enough distance to reward the risk. Without that balance, early entry is not skill. It is merely impatience with a tighter aim. So the mathematical question is not, will this reversal happen? That question is too proud. Ask instead, what do I lose if this idea fails, and what can the market reasonably give if it succeeds? Once you begin thinking that way, the chart stops being a place to prove yourself. It becomes a place to measure terms. And after the terms are measured, the next matter is more demanding. What must the market actually do to show that this possible reversal is becoming real behavior? The first break against a trend attracts attention because it feels like proof. A support level gives way. A rising line is broken. A sharp candle cuts through the rhythm that had been holding for hours or days. But the first break is often not the reversal. It is only the market asking a question. A strong trend does not usually die from one wound. It dies when it can no longer recover properly. In a healthy advance, weakness should be met by buyers with confidence. Price should reject lower levels quickly. Failed selling should turn into renewed demand. If that still happens, the break was only a disturbance. The trend was tested, and the trend answered. The deeper signal comes after the break. Watch the response. Does price reclaim the broken area with force, or does it struggle beneath it? Does the next rally travel easily, or does it stall where buyers should have stepped in? Does the market punish sellers, or does it begin to reward them for pressing? A reversal begins to take shape when the old side of the market loses its ability to repair damage. This is where multiple timeframes become useful in reading behavior. The lower timeframe often shows the first fracture. It reveals the change in tempo before the larger chart admits anything. You may see failed pushes, sharper pullbacks, weaker recoveries, and more time spent below levels that previously held. Alone, these details may be too small. Together, they show the trend is no longer moving with the same authority. The working time frame then tells you whether those small fractures are becoming structure. A single lower time frame failure can vanish quickly. But when the market begins making lower highs after an uptrend, or higher lows after a downtrend, the behavior has become organized. The pressure is no longer just a reaction. It is beginning to form a new pattern of acceptance and rejection. The higher time frame gives consequence. It asks whether the change matters beyond the immediate noise. If the larger chart still accepts the old trend, smaller failures may be absorbed. But if the larger chart begins to close poorly, reject continuation, or accept price back inside an area it should have left behind, the reversal attempt has gained weight. The market has moved from interruption to possible transition. A useful way to read this is to study what should happen, then notice what fails to happen. In an uptrend, a breakout should attract buyers. If it breaks out and quickly falls back, that is information. A pullback should hold above prior support. If it cuts through and cannot reclaim it, that is information. A rally after weakness should show confidence. If it rises slowly and fails early, that is information. The same principle works in a downtrend. Weak markets should reject strength. Rallies should fail cleanly. Breakdowns should attract fresh selling. If price stops responding that way, if sellers press and get no reward, if breakdowns are quickly recovered, If rallies begin holding instead of fading, the old pressure is losing command. You are not looking for one dramatic sign. You are looking for a change in behavior that repeats across time frames. One break can be a trap. One rejection can be reaction. One candle can be emotion. But repeated failure at places where the trend should have continued tells you something different. It tells you that the market is no longer paying traders for following the old direction with the same ease. This is the practical reading of a true reversal. First comes damage, then comes the failed repair, then comes acceptance in the opposite direction. Damage alone is not enough. The failed repair matters because it shows the old side tried to regain control and could not. Acceptance matters because it shows the market is no longer treating the new price area as temporary. So when you see the first break, do not be impressed too quickly. Market, watch the response. Let the market show whether the break is being rejected, repaired, or accepted. The trader who understands structure does not chase the first sign of weakness or strength. He waits to see whether the market can still behave like its former self. And once behavior begins to change, the next challenge is not seeing it. The next challenge is deciding how much weight that evidence deserves before your bias must change with it. A trader who opens charts without a fixed routine is already giving the market too much authority. He may not notice it at first. He begins with the daily chart, then jumps to the 5-minute, then checks the hourly, then returns to the daily because the smaller chart looked too aggressive. Before long, he is not analyzing. He is wandering. Multiple time frames are useful only when they are approached in a consistent order. Without order, every chart becomes a fresh argument. One time frame gives caution. Another gives speed. Another gives distance. If you consult them randomly, the market will always provide some reason to act and some reason to hesitate. The problem is not the number of charts. The problem is the absence of a disciplined sequence. A professional habit begins before the setup appears. You decide in advance which time frame defines the broad condition, which time frame carries the working structure, and which time frame is allowed to refine the actual trade. This is not done because the market is simple. It is done because the trader must be simple in his process. The more complex the market becomes, the more important it is that your method of reading it does not change with every candle. Start with the chart that sets the background. This is where you mark the larger direction, the major areas of prior response, and the places where a reversal would have enough importance to deserve attention. You are not searching for an entry there. You are establishing the field. If this step is skipped, the smaller chart can make a minor movement look larger than it is. Then move to the working time frame. This is where you study whether the market is still behaving in line with the larger condition. Is the trend advancing cleanly? Is it becoming heavy? Are reactions beginning to travel farther than they did before? This chart should be the main place where you form your working view. It is close enough to show change, but not so close that every small movement demands interpretation. Only after that should you look to the smaller time frame. Its role must be narrow. It should help you see detail, not rewrite the entire opinion. If the small chart is allowed to overrule everything too early, your routine has failed. A precise view is useful only when it serves the larger read. Precision without hierarchy produces fast mistakes. The order matters because it protects your analysis from being reshaped by the last thing you saw. A strong candle on a small chart can dominate the mind if you have not already established context. A slow higher time frame can make you ignore developing weakness if you have not already defined what change should look like on the working chart. Routine gives each chart a proper voice and prevents any one of them from speaking out of turn. This habit also makes review possible. After the trade, you can ask clear questions. Did the larger time frame actually support the idea? Did the working time frame show the behavior I claimed to see? Did the smaller time frame provide timing, or did I use it as an excuse? Without a routine, review becomes vague. You cannot improve a process you did not follow. Your routine should be written plainly enough that you can repeat it under pressure. First, define the larger condition. Second, examine the working behavior. Third, use the smaller chart only for refinement. Fourth, record which time frame carried the decision. A trader does not need a complicated ritual. He needs one he can obey when price begins to move quickly. The market will test the routine at the worst possible time. It will move before you finish your review. It will break a level while you are still deciding what matters. It will show strength on one chart and weakness on another. If your order of analysis is not already fixed, you will create one in the moment, and a process created under pressure usually serves the pressure. So build the habit when nothing urgent is happening. Read the charts the same way when there is no trade as when there is one. Let repetition remove negotiation. Then, when a possible reversal begins to form, you are not asking which chart to believe first. You already know where to begin, what to inspect, and which evidence belongs in which place. But once the trade is open, the work changes. The same time frames that helped you prepare cannot all be given the same power over your exit, your patience, and your protection. The moment a reversal trade begins to move in your favor, a new problem appears. The chart that helped you enter starts producing every small hesitation in detail. A minor pullback looks personal. A pause looks dangerous. A shallow rejection feels like the market is about to take back what it has given. If you let the smallest chart manage the whole position, you will often leave just as the larger move is beginning to wake up. The entry time frame has a limited duty. It helps you test the idea. It shows whether the first pressure is holding or failing. But once the trade begins to work, that same time frame can become too sensitive. It sees every breath as an event. It magnifies normal movement into warning. If you obey it completely, your management becomes nervous, and nervous management turns decent reversal trades into small, forgettable gains. The larger time frame must be given a different role. It is the chart that can pay you if the reversal becomes meaningful. A true reversal does not reward the trader only because he entered well. It rewards him because the larger participants begin to adjust, reduce cover, chase, or defend from worse positions. That process takes time. If your exit is controlled only by the fast chart, you may never allow the slower pressure to express itself. But this does not mean you ignore the lower time frame after entry. That would be another mistake. The lower time frame is still useful as an early warning system. It can show when the move is losing sharpness, when the opposite side is beginning to absorb pressure, or when price is failing to continue after it should. Its job is not to frighten you out of every reaction. Its job is to tell you when the original pressure is no longer acting as it should. Each time frame must have a job after the trade is open. The higher time frame defines the larger opportunity. The working time frame judges whether the reversal is developing properly. The lower time frame helps you protect risk when the behavior becomes suspect. If all three are allowed to control the exit at the same time, you will have conflict. If none of them has a defined role, you will manage by feeling. A reversal trade often needs room because it is fighting the memory of the old trend. There will be counter moves. There will be tests. There will be traders who still believe the prior direction is intact. These reactions do not automatically mean the reversal has failed. Sometimes they are the fuel that later strengthens the move. When late traders defend the old side and fail, their exits can push price farther than early profit taking ever could. The question is not, has price moved against me on the small chart? That will happen often. The better question is, has the trade stopped behaving in a way that supports the reversal? There is a great difference between a normal pause and a failed follow-through. A pause respects the developing move. A failed follow-through gives back important ground, cannot recover when it should, and begins to show that the other side is regaining control. You must also decide in advance what kind of evidence will make you reduce risk. Do not wait until the market is moving against you to invent the rule. Perhaps the lower time frame can justify tightening exposure. Perhaps the working time frame must break before the trade is considered damaged. Perhaps the higher time frame must fail to confirm before you stop expecting expansion. The exact method can vary, but the hierarchy cannot be improvised. The practical aim is simple. Protect yourself with the faster chart, but do not let it steal the larger chart's reward. If the lower time frame warns you, listen. If it merely complains, observe. If the working time frame remains healthy and the higher time frame is beginning to shift, give the trade a chance to become more than an entry. Good management is not blind holding. It is knowing which evidence deserves action and which evidence only deserves attention. This is where many traders lose the value of multiple time frames. They use one chart to enter, another to hope, and another to panic. Before we go deeper, we have to name those mistakes clearly, because most failed reversal trades do not fail from lack of charts. They fail from using the right charts in the wrong way. The trader who misses his multiple time frames usually does not fail because he lacks information. He fails because he gives the wrong meaning to the information he already has. The small chart moves sharply, and he calls it early insight. The large chart moves slowly, and he calls it safety. Then, when all the charts finally agree, he calls it confirmation, though the best part of the move may already be gone. The first mistake is confusing noise with knowledge. A lower time frame will often show dramatic movement before anything important has changed.